Hey, good evening, everyone. Marty Mazzori here. It's May 19th, 2022, Thursday, with your weekly economic update. So we'll do the usual. We'll look at our index score for the week. We will take a look at a handful of the inputs, and then we'll do a quick market snapshot on the S&P 500 index. So here's our graph of our index since we created it back in July of 2017, and then we back tested it a couple decades back. 8.7, pretty low score. I can see why more and more of the punditry is suggesting that we are about to enter a recession if we're not in one already. That's not our assessment. It will be if and when we get below the zero line here, as we did back here in August of 2019. Now what I want to do is once again just take a look at our history here, and I want to note that we got down all the way to an 8 during the European debt crisis back here in 2011. Here we got pretty low with a score of 18. So it's not unheard of to have a score this low. The trajectory, of course, is pointing in the wrong direction. However, right now our assessment would be more of what you'd call maybe really actually more in here, what you might call a mid-cycle slowdown in the economy. That in here took the market down about 16%, top to bottom. So here, there's just more shaking out to come. Right now, our assessment is that recession is off the table for the moment. However, that's always subject to change. And we could end up right in that crowd in the coming weeks that says that recession is imminent. Not our base case. So retail sales came out on an annualized basis. We were up just a little bit from the previous month. So certainly rising retail sales does not suggest that we have recession risk. However, this is a nominal calculation. Therefore, we have to address to what degree is it just rising prices as opposed to volume of sales. And it's actually almost all of it is rising prices, meaning inflation is running about at the rate of retail sales. Therefore, real retail sales have just barely budged. Certainly not bad, certainly not recessionary, but it's not necessarily something to get overly excited about. Mortgage purchase applications continue to go in the wrong direction. We know that mortgage rates are very elevated. We know that the price of homes is very elevated. As you'll see in a minute, the home builder confidence is rolling over as well. Looking at the housing starts data out this week, off a little bit from the previous month. However, actually single-family homes were down notably, whereas multifamily construction, right, apartments, 5 units or more, are actually holding up pretty well. And it makes sense with the incredibly high rents these days. High prices are inspiring the build out of more capacity to take advantage of those higher rents. Permits, which of course precede starts, and that therefore when permits are rising, we expect the coming month or months of starts to rise. Well, permits are falling off as well, dramatically so in the single family relative to multifamily, and both of those are in this graph right here. So the NAHB Housing Index, or the Home Builder Optimism or Sentiment Index, which we prefer to call it, it fell 8 points to 69. The estimate was for 75. That's the weakest since June of 2020. All components in the index saw declines. Present situation was down 8 points. Future outlook was down 10 points. Prospective buyers traffic down 9 points. Their chief economist comments: building material costs are up 19% from a year ago. In less than 3 months, mortgage rates have surged to a 12-year high. And based on current affordability conditions, less than 50% of new and existing home sales are affordable for the typical family. Entry-level and first-time homebuyers are especially bearing the brunt of this rapid rise in mortgage rates. Obviously, it's clear that the housing market is beginning to roll over. Now, is it going to roll over into a deep recessionary kind of scenario? Maybe not. I just listened to one of our research partners sound bullish right now. He acknowledges what I just referenced, but he says, there's still a lack of inventory presently. The time on the market is still relatively tight. Yes, we will get some slowing, but he thinks that's temporary and that things are going to pick right back up. I'm not nearly as sanguine as he is, but again, I'm still not in that overall recession camp. I think all of this makes sense within the context of a real pause and a cooling of the economy for the time being. Initial jobless claims, a lot of talk about how it's gone up the last couple of weeks in a row. The expectation was for 200,000, it was 218,000. However, continuing claims are at a low we haven't seen since 1969. So again, you do very much want to pay attention to the direction, right? Even though it's, historically low, it does begin to rise, just leading into recessions. However, it tends to rise from a much higher level, right? So it's hard to panic over the economy. I think it should be difficult to call a recession, unlike what a lot of people are doing, when we have very few jobless claims, very few continuing claims, and 11 million job openings. Yes, absolutely. Anecdotally, we are seeing companies beginning to pull back a bit on the hiring. Are they laying people off at this point? No. Are they considering that in any way, shape, or form? No, not across most industries. There's going to be some, and there's going to be some of that to come in a slowdown. Just not a recessionary look, though. Industrial production picked up a little bit. Again, not a recessionary look, right? This is a recessionary look here, right? This is a recessionary look. This is a recessionary look. This isn't capacity utilization. To what degree are factories running at or near capacity? That's elevated as well. Again, this is what you see when you're really slowing into a recession, right? Is a rolling over of the utilization of factory capacity. Well, we don't have that now. We have a real picking up. Leading economic indicator index came out this week. We track the ratio of leading indicators to coincident indicators. And this has been a pretty good indicator historically, and it's rolling over. So that would be bearish for the economy. But again, here's that 2011 that I referenced there initially. And here's that 2015, 2016, which I'll call that mid-cycle slowdown, right? Started to have it here, mid-cycle was a slowdown that just kept slowing. And we ended up in that big recession in 2008. Here we had it in the mid-90s, mid-cycle slowdown, right? Mid-cycle slowdown, then finally. That's what this feels like, folks. The U.S. Economic Surprise Index doesn't surprise me that that's dropped here below zero. So again, this doesn't say that recession is imminent. This says that economists were overly optimistic about the data to come relative to actually what happened, meaning that they were expecting X, which was higher than Y, and they got Y. And so then what happens inevitably is economists ratchet down their expectations, and then we beat to the upside. But this is a red flag. Raw industrial materials, right, rolling over here a little bit. Okay, so that suggests a come down of inflation, perhaps. The price of copper had quite the correction. We were calling for that, quite frankly, kind of wanting that. However, it got really exacerbated the downside. You can think China locking down all of Shanghai and parts of other places because of the Omicron variant. Well, they've had several days now without any new cases. They're talking about opening up. Got a little bit of a pop this week in copper. I'm very bullish on copper long term for all the reasons we've been writing about for the last couple of years. But again, so that's a disinflationary force right here as well. However, I do expect copper to probably ramp up again in the not too distant future, frankly, as China opens back up and as they start spending money on infrastructure to try and rejuvenate their economy rather quickly. And then I'll finish up on the economy with the Baltic Dry Index. So folks, this is the cost of shipping across the world's ocean. Again, typically, you're not rising like this if we're about to enter a global recession. This is what that looks like, right? I'm going to skip this one for a second. Typically, activity is slowing, therefore the cost of shipping is slowing. Well, we had a huge ramp up here. A lot of that had to do with China, building their ghost cities and so on and so forth, utilizing something like 60% of the world's copper. So the Baltic Dry Index just went through the proverbial roof. So you can say that it's certainly not pessimistic in terms of what it says about the economy. And it's certainly not something that's weighing down on inflation, right? Quite the opposite as well. So folks, in a nutshell, a mixed picture. Obviously, growth is slowing. I can keep rambling, but stay tuned. There's a lot of pushing and pulling from different angles within the economy, and we'll continue to parse it, try to make sense out of it, and report to you on it herein. Just wrapping up, we'll go ahead and start back at the 60-day, 60-minute chart. We had the falling wedge, bullish divergences, and so on. Had the breakout, ran through here. We've had this, this notable sell-off, almost back down to these levels right here. You can see that it looks kind of like a bear flag, right? And if it is, we've got further to go. So time will tell. Right now, jury's still out. Market could go either direction here. Could get a nice pop. Could resume that rally that I expected to take us all the way back up here to 4,300. The one-year daily chart, not a great look. Not a horrible look when you look at the RSI relative to the pattern. However, you do have a market that looks like it's continuing to follow these flag patterns lower. And so this would suggest that right around that 3,800 mark, which is a key Fibonacci retracement from the bottom during the COVID lockdown, that I think would get bought. So we'll see. And on the weekly chart, you can see that 38.2% retracement. You could really see the market, catch a bid right in here. And that 50% retracement falls right on our current price target, which I'm saying is 34.50. We think that could very well be the worst of this sell-off. If we fall there precipitously, that would be the best scenario for how we're positioned, because we have these put options that would just explode in value and give us lots of capital with which to deploy at a level that we think makes a lot of sense. Unless we're in recession, then if you take it down to a typical bear market, it's about a 37% decline, which would take us right into this 3,000 mark in here. So folks, we'll keep you posted. I will leave it there. Appreciate you all for watching and listening. Catch you later. Take care. Bye-bye.